Hello, everyone. Luckily, we have Anthony Zhang from University of Chicago. He's a professor there, and he's also a mini crypto Twitter influencer. So welcome, Anthony. Do you want to give a quick intro of yourself as well?
Sure, great. So hey everyone, very happy to be able to virtually visit. So I'm Anthony. I am at Chicago Boost, started here 3 years ago. My day job is like mostly TradFi, moving in the direction of DeFi. This is one of the DeFi papers that I have. I also like writing, substacking, podcasting about DeFi and Web3 topics. So yeah, that's kind of me. Okay, so I guess I'll jump in. I'll tell you guys about basically a paper that we're working on with Sagom O and Sam Rosen at Temple on basically NFTs, trading NFTs, and what the returns are to different investors in the NFT market, basically. So the audience for these set of slides is basically economists and finance people who may not know what NFTs are. This should not be super necessary for you guys that basically monkey pictures are selling for absurd amounts of money, right? So here's a golden ape, here's a punk, here is a, what is this, Fidenza or something, and these are selling for absurd amounts of money. By the way, but please feel free to interrupt me, just jump in with any questions as you have them. Yeah, like post in chat or raise your hand or anything. Yeah,
I'll read out the questions in chat if anyone
great.
has questions.
And so basically, there's been some sort of traditional institutions who've also started looking into NFTs, adopting these things. And so some examples, Adidas did a drop that sold very well. And NBA has their Top Shot system. Australian Open has an NFT system. British Museum is looking at NFTs, so lots of interest. So this is a really quickly growing new asset class, right? NFTs are kind of interesting as a asset to invest in relative to like say equities or bonds or something like that, right? Because of the fact that you can't just like buy the market. So if you want to buy stocks, right, you can just say, I don't really have any ability to pick stocks. I'm just going to buy the S&P 500, right? You can basically do the same thing for the bond market, right? You can sort of do this for crypto because everything is like divisible and there's not a gigantic number of coins. So you can just go and buy a bit of everything and basically track a market index, right? You can't really do this for NFTs because they're indivisible and most of them are unique, right? So just the same way how if you want to buy exposure to the housing market, you have to buy a house, right? When you want to buy exposure to the NFT market, you have to buy an NFT or a set of NFTs. And then so the quality of your exposure to this market can matter as much as the performance of the asset class overall, right? So the idea is the NFT market could be doing well, but if you buy a bunch of stuff that's garbage, you're going to do badly, right? So the interesting thing about markets like this, and some TradFi markets that look kind of similar to this are basically housing markets, venture capital, private equity, right? The quality kind of your exposure can matter as much in these markets as like how the market as a whole is doing. And so as a result, people who are more experienced, who are able to have higher quality exposure, better investments, could have pretty large advantages over entrants who sort of don't really know what they're doing in these markets. So that's what we're trying to look at in this paper. How much better do experienced investors do in NFT markets? How big is their outperformance and what kind of are the drivers of their outperformance? And then so we're gonna get a data set of NFT collections and transactions on Ethereum. We're gonna find basically that the experienced guys do quite a lot better. So when we compare trades with the same time horizon, the experienced guys are making like 8.6 percentage points more per trade. And then we can also ask, how are they doing better? And then it turns out that how they're doing better is entirely because of the following. Mints are much, much, much more profitable than secondary market trades. So buy in a mint and then sell, you make a lot more money for the same holding period than if you buy in secondary market and then sell, right? And the entirety of the experienced investors' outperformance comes from the fact that they mint more, right? Conditional on minting, if you compare two trades, one experienced, one inexperienced, they both mint, experienced guys don't do better. They do slightly worse because they actually pay higher fees when they're minting. And I'll show you like why this is when I talk about this. They do slightly better in secondary markets, so they slightly overperform. And basically, this is not due to actually picking good collections, but it's due to sort of selling at high prices. So in secondary markets, we find some evidence that the experienced guys are able to select NFTs that are like pretty high quality within a collection, buy them at slightly higher prices, and sell them at much higher prices. So one of the things I want to emphasize is that we didn't find that much evidence overall that on average, your experienced guys have inside information. So they're not doing better in minting. And in secondary markets, they're doing better through superior execution rather than sort of picking the collections that are doing well, right? And then so basically what we think we showed here that's somewhat not documented yet in the literature is basically that there's this novel mint premium. Mint prices seem to be systematically too low, and there's very high profits from participating in mints in particular. Experienced guys are able to harvest the mint premium. They don't seem to have superior information. It's not really that experienced guys on the whole know where the market is going, right? And this basically characterizes, there's all this like Chicago school view that markets are efficient. You can't really predict returns. Nobody should be able to get better returns in the market. We found basically some inefficiencies. It looked like that the experienced guys are able to exploit, and new entrants may sort of be in a disadvantaged position because they don't sort of have these have the ability to exploit these inefficiencies. So I guess I'll stop there. Are there any questions so far? Okay, so going on, I'll skip related literature for reasons. Okay, I'll mention briefly. So we fit into some literature on NFTs. There's some older work on art. NFTs are kind of interesting because like you can ask questions like those that have been asked in art markets. We have very, very good data because all these trades happened on blockchain, right? And then there's some other literature about how experienced investors do in like venture capital, private equity, housing, so on and so forth, right? Okay, so let me jump in. I'm going to go through this part relatively quickly because all of you guys know this stuff already. So NFTs are digital assets. They're held in your MetaMask. They can be seen as long as anyone knows your address. There's a private key. This is like basically blockchain 101 for the non-blockchain academics, right? Private keys allow you to buy, send, and trade them. And then unlike other crypto assets, NFTs are unique and indivisible, right? And then, so here's OpenSea. That's how you trade these things. Somebody sets a price, you buy, and then you can make offers and so on. Why do people buy NFTs? Here's me. I have a number of followers. Here is a guy with a hexagonal profile picture. He has basically shown the world that he has a lot more money than me. So basically, you can think we think of NFTs as like durable digital status goods. And so a tweet from a friend of mine, which I think captures NFTs, how I think about NFTs nicely is basically like NFTs are like country club Skynet, right? It's kind of like you in the previous world, you buy a Ferrari and you drive it up to the country club, right? Now you buy an ape and you roll it up to crypto Twitter, right? So it's like a verifiable signal that you have a lot of money, and perhaps taste depending on what NFTs you own. And then it gets you into private chat groups, private Discord, so on and so forth. Occasionally, some of them have like things that they let you do in video games or virtual worlds and so on. But yeah. So returns have also been high. So besides the fact that they have like some value in terms of access and status, they also attract a bunch of speculative investors, right? So what we did is that we gathered data from scraping Etherscan, and then based on OpenSea's collections, or a list of collections from top collections from OpenSea. And then we got a total of 692 generative collections. And we defined a generative collection basically as similar NFTs. So like Bored Apes is a generative collection. I think we don't have CryptoPumps, but like the Cool Cats is a collection, Subdocs is a collection, so on and so forth, right? And then we put a bunch of manual work into cleaning up these collections and then sort of organizing them. Our generative collection, so we basically throw out some one-of-a-kind NFTs that don't fit into collections because for our analysis, it's useful to focus on collections. And then these are basically half of primary market sales from around April 2021 to September 2021. So we have 2.9 million NFTs. And then we get the collection level info from manually looking at the websites. We get transaction level info from the Ethereum, from the Etherscan. So we have 6 million transactions in total. We have around 3 million mints. And then we have 6 million transactions, of which around half of them are mints, half of them are a secondary market. And then we observe everything we see on Etherscan, so the date, the price in Ethereum, any fees paid, so this is royalties, OpenSea transaction fees, and gas fees. We see the item, and we see the buyer and the seller. And then we see the mints, we see the secondary market trades. We throw out LooksRare basically because LooksRare is sort of, there's a lot of watch trading, and that sort of screws up the prices of it. Yeah. Okay, so here's an example of a generative collection, subducts, right? It has 10K items, meets our definition of a GC, and then here are a couple of subducts. Okay, so now I'm going to show you a couple stylized facts about what these mints and trades kind of look like in our data, right? And this will be like familiar to some of you who've spent some time in these markets. So here's a plot, and then on the x-axis we plot the time, and then on the y-axis we plot the price of a trade, and then we plot mints with these circles, and then we plot secondary market trades with these triangles. And I think a note about how this system kind of works is that, so there's this mint period, right? And you see a bunch of people minting. The mint price effectively acts as a ceiling for the secondary market price until the point at which the collection mints out, right? And then why is that? The reason for that is because if I could get a subduct by paying like 0.1 ETH, or I could buy a subduct on the secondary market, if I don't really care which subduct I get, there's no reason not to just mint one, right? And then so basically the mint price serves as a ceiling. And so you see basically that as subducts get to the point where they're close to minting out, this is when secondary market prices start like rising, right? So the way this kind of works is that collections that sort of mint out will tend to experience secondary market price increases. Yeah, so I'll talk about a couple stylized facts. Primary market outcomes in our data are surprisingly bimodal, right? So how many of these GCs are able to mint out their entirety of their collection and then do well? If we simply plot here for all our 690 collections, the number of items minted over the Genesis supply, the total amount available to mint, you see an interesting bimodality, right? So you either sell everything, or if you don't sell everything, basically you sell like not that much stuff at all. You sell like something like 10 or 20% of stuff, right? And then so this is like kind of intuitive. You either basically are very successful, everyone thinks you're successful and you mint out, or you just never get any traction and nothing is ever sold, right? And then sort of as you might expect, if you're here, secondary market prices grow for the reason that I mentioned, which is that only when you sell out do you lose that kind of ceiling and prices are allowed to grow. The other fact, which is again, and this is all kind of stylized facts which are useful to understand our main results on basically like how experienced investors are, how much experienced investors are doing better. So the other fact is basically that collection level price movements are an important driver of price movements, right? So most price variation is at the collection date level. So how do we do this? What we do is a very simple regression framework where we basically take log prices, regress them on collection date fixed effects and an error term, right? And so this basically decomposes variance of log prices of NFT trades into the variance of collection level prices, right? And then sort of an error term. And we can ask basically as a variance decomposition, how much of the variance in prices is composed of the variance of the collection level price index versus the variance of the residual term, right? What we see is that the price residual around the collection is like pretty sort of normally distributed. It has a kind of long tail, so there are some items within collections that are very rare and then trade at a very large number of times greater than the collection level price, right? However, the R squared from this regression is fairly high. So around 80% of price variation across trades is at the GC date level, the collection date level, right? So fairly obvious that when apes are doing well, all of the apes are pretty much doing well. Okay, so the question, did I have a way of factoring into account NFTs that go to 0? And then, so yeah, in our main results, we're only looking at sales. It's very important to account for your question. So what we do is we use this price index. We're going to value the NFTs that are not sold using the median price of the GC date at the time that sort of at the end of our sample. And then in particular, we're also going to take into account if a secondary market for an NFT collection basically totally loses volume, then we're going to assign a value 0 to that and then sort of use that value 0 in our regressions. And so this is a bit of a judgment call. You have to like make some cutoff where you decide this thing is basically worthless. Our main result that experienced investors do better survives basically doing accounting for NFTs that are held to the end of our sample period. Yeah, did that answer your question? Great. the main topic of our paper is to look at experienced versus inexperienced investors. And so the next stylized fact is about sort of what's the distribution of experience in our data. So what do we mean by experience? Here's what we're going to do. We're going to make a plot here of the number of collections that you, distinct collections that you minted from, right? And then we're going to make a cumulative plot, which plots basically, if you minted from like one collection, everyone who minted from at most one collection, so very novice investors, what fraction of the market are they, right? Everyone who minted from at most two collections, what fraction of the market are they, right? And here you have the whales that have minted from 100, 200 collections, so on and so forth, right? And you find basically that sort of this market is like fairly concentrated. What happens is that some 3% of wallets, right, that are experienced make up something close to half of all the trades in our data, right? So this is not super surprising that this is kind of a whale-dominated market. Half of NFTs are traded by like roughly 16,000 wallets that are doing a very large number of trades. So what we are going to do here is define a cutoff where sort of you're experienced if you are above some number of NFTs traded. What we're going to do is we're going to pick the cutoff such that half of the trades roughly are defined as experience, right? So then we picked a cutoff 6. So then if you minted from at least 6 collections and you traded NFTs from at least 11 collections, we're going to define you as experienced in our data, right? And then so here what we're saying is that we define you as experienced if you mint from at least 6 generative collections, and then you trade items from at least 11 generative collections, right? And these are basically picked to target 50% of mints by experienced wallets, 50% of trades by experienced wallets. After we interact, we get more like 30%, but so we get like 3% of wallets are experienced. An important fact for getting our analysis right here is also that we define experience in a totally backwards looking way, right? So what we're going to do is at any time, say March 2021, or say like March 2021, right? We're going to look before March and see who made more trades, who made more mints, and then define who's experienced. And then look forwards to see how much returns are these guys getting after March, right? And so we basically have a different set of experienced guys for every date. And this is important because like we don't want to look forwards in defining experience. Otherwise, we have potential like reverse causality. Basically, guys who are doing well continue to trade, and that's kind of what we see. So then I just note that our definition of experience is backwards looking. Any questions about my definition of experience here?
Quick question. So on the trade side, so you're filtering by number of collection traded.
Yeah.
Okay, you're not filtering based on how many trades this wallet.
Yeah.
Well, is there like a particular reason you didn't choose that?
It's a judgment call. We should probably do a robustness check for that. Yeah, let me make a note of that. Yeah, I think it should not make too much of a difference, but it's a check we should maybe do. Yeah.
Thank you.
Okay, so going forwards, here's a couple of facts that just show like what's the difference between experienced and inexperienced investors. Inexperienced investors trade more frequently. This is kind of obvious because they make more trades overall. Their trading patterns are kind of slightly different. And then two stylized facts that are going to be important is number one, experienced guys are going to hold for much shorter times on average than inexperienced guys. So basically, if you see here we make a plot of the distribution of holding periods. And you see basically that, and here you have the log days until they sell a thing. And then here you have the fraction of experienced versus inexperienced guys. And you see that there's a much larger mass of experienced guys who basically hold for very short time periods and then sell. Inexperienced guys are holding for much longer time periods on average. So the experienced guys kind of behave like flippers. They're buying, they're not holding for very long, and then they're kind of flipping it relatively quickly. Experienced guys also mint quite a lot more. And then so basically this plot shows that the fraction of experienced investors, every data point is a day. The fraction of their trades in a given day that's mints tends to be much higher than the fraction of inexperienced investors' trades that are mints. And then so experienced investors tend to mint more. Okay, so now the main results of the paper are on how much better are experienced investors doing and why are they doing better. And then the core results are that experienced investors are doing like 8.6% better. The entirety of their outperformance is explained by the fact that they mint more. And conditional on minting, they do slightly worse. And then in secondary markets, they do slightly better. So here's the first plot where we just like very simply look at the average return realized by experienced and inexperienced guys. What you basically see is that even when you don't control for anything, on any given trade, the experienced guys have a distribution of returns for each trade that's slightly better. Compare the pink region with the white region, slightly better than the inexperienced guys. And if you just aggregate how much the experienced guys made per ETH that they invested, right? The experienced guys are doing slightly better, 71% over 63%. So these are like crazy returns on average. Everyone's doing well in this market in our data, but the experienced guys are doing better than the inexperienced guys. Okay, so now we're gonna sort of more carefully compare experienced and inexperienced guys. So what we're gonna do is we're gonna look at realized returns. And so realized returns are basically the sale price of the NFT minus fees, minus the purchase price, minus the gas price upon sale, and then divide by how much you paid to purchase it and how much gas you paid to purchase, right? And this is like ETH on ETH returns. Then we're gonna run regressions, and then we're gonna regress these returns on a dummy for a seller experience. And then we're going to regress them on a set of controls, which include basically holding periods, mint versus secondary, and a bunch of fixed effects. And I'll kind of explain what these different specifications do in the next couple of slides. So here's a regression table showing the result, right? When I first regress returns on experience, I get a negative coefficient. So this says that on the average trade, the experienced guys are doing 4.6% worse than the inexperienced guys. And so we're a bit puzzled, why is this? Now, the reason for this is because on every trade, right, your return is kind of, in a market which is rising, the longer you hold on to an item before selling, the more you're going to make, right? And so I told you that experienced guys have much shorter holding periods. And then so they hold on to these NFTs for a lot shorter on average, right? And so we thought that part of this is likely driven by the fact that basically experienced guys are holding for shorter periods. What that means is that if you control for a holding period and thus effectively compare trades between experienced and inexperienced investors with the same holding period, then you should reverse this result. And indeed, what we find is when you control for holding period, the longer you hold, the more you make on average, right? This is just the market is rising, the longer you hold, the better you do. And then once we control for holding period, we find that experienced sellers do around 9.3% better than inexperienced sellers. Yeah. Another thing we can do, which is like a better control for holding period, is we can control for buy date and sell date fixed effects. And so what this means is that we control for a very rich set of fixed effects. This basically does the following comparison. We're going to find an experienced guy and an inexperienced guy who bought and sold NFTs at exactly the same dates, right? So I'm inexperienced. I bought maybe in March of 2021, and I sold in October. Kaido maybe is a huge whale, and then he bought at exactly the same dates, right? And then that kind of even more strictly controls for like, it's really not the aggregate markets that's driving this effect. And then in this regression, we find that Kaido does better than me by 8.6%. So experienced investors, this is kind of the headline result, get around 8.6% higher returns per trade. The raw outperformance is negative, but that's basically because of holding period, right? An interesting fact, which we're going to come back to, is that the experienced investors' outperformance is much higher. It's like 30%, but we don't account for fees. So the experienced guys are actually buying collections that do well, but they get hit a lot in fees. And then after you account for fees, transaction, royalty, and gas fees, the experienced guys' outperformance declines substantially to around 8% or so. Any questions?
I think I might have missed this. What was the time frame for the data? And for the record, I'm definitely not a whale.
Yeah, so we have data from March 21 to March 2022. Yeah, I believe. Yeah. Okay, so now we want to ask basically what explains experienced investors' outperformance, right? And we notice basically that experienced investors mint more. Here, what we're doing is we're running a regression of returns on a dummy for whether the trade was a mint. And what we find is this massive effect, which is that mints are like around 113% more profitable than secondary market trades. And this is true when you control for holding period. This is also true when you add fixed effects for buy date and sell date, right? And so basically mints do dramatically better than non-mint transactions. And then so if mints do better and experienced guys mint more, a part of the experienced investors' return premium can reasonably be attributed to their propensity to mint, right? And so what we do here is that we control for whether a trade was a mint and holding period and see how that changes experienced investors' return, right? Well, we find that dramatically decreases the estimated effect. Experienced investors, after controlling for mint, actually underperform inexperienced investors. When we add buy date, sell date, mint fixed effects. So compare two trades, one experienced investor, one inexperienced, where they bought and sold at the same dates, and then both trades were either in secondary markets or in primary markets mints. We find that the experienced investors do around 2.2% worse. So this is the result that sort of what I mean when I say the higher propensity to mint explains the entirety of experienced investors' outperformance. This is what I'm saying. After accounting for whether the trade was a mint, experienced investors no longer outperform inexperienced investors. So mints fully explain inferior investor return premium. Then what we're going to do is we're going to ask, let's look separately at mints and secondary market transactions and see sort of how much better are experienced investors doing in either. And then we kind of expected to see this negative 2.2% show up kind of both in mints and secondary. But we were somewhat surprised to see experienced investors do quite a lot worse in mints. They do around 6% worse on the average mint compared to when the inexperienced guys actually do mint. And in secondary markets, they do a bit better. And then so in the rest of the paper, we try and look through basically what's driving the difference in returns in mints and secondary markets. Let me pause here. Any questions? All right. So going forwards.
I have one question actually on the fixed effect. When you sell and when you buy, shouldn't that be included in the experience itself?
So we don't. You can think of it as like, again, if you're a whale, right, but you happen to buy and sell an NFT at the same time that someone who wasn't a whale, like think about it, like take like June last year, right? And then you've been trading a bunch until June. I just decide to enter the market in June, right? And then both of us buy one in June and then sell something in October or something like that, right? So that's kind of the comparison I'm doing. That's why I don't think that I have to control for like sort of the buy date, sell date doesn't really affect experience, if that kind of makes sense. Yeah.
Okay.
Yeah, so there's a question from Arjun in the chat. Is there a difference in returns between bullish and bearish phases of a market? Do experienced investors take a larger loss during bearish phases? Yeah, we ran that. I forgot the exact results. The experienced investor premium, I think, like changes a bit over time. Yeah, that might show up things in a future version. I remember we found something, but I don't remember exactly what we found. So check a future version of the paper. We'll probably have that. Yeah, great question. Yeah. Let me just make a note of that. Okay, so in mints, let me see what I have. An interesting fact that we find is basically that experienced investors enter mints later. So we were a bit surprised to find this because you might think that if I'm a whale, everyone gives me access early, and so I should mint earlier, right? Here, we define relative entry as at what point between 0 being the first NFT minted in a collection and 1 being the last NFT minted, at what point do experienced investors enter, right? And we find that the inexperienced guys kind of buy like somewhat uniformly over a collection. The experienced guys make more of their buys towards the end of a collection's mint period, right? So it looks to us like what the experienced guys are doing is not so much like, oh, I got like whitelist access early and then I minted really early, right? It looks to us that they're basically watching these collections, and then when something looks like close to minting out, then you jump in and buy stuff, right? And then the cost of this is basically that sort of, if you look at gas fees compared to relative time, right? What happens here is basically you buy early, there's not much congestion, right? You buy close to the end of the mint period, and then there's a bunch of congestion, and then gas fees are relatively high, right? And then so late mints have much higher gas fees. This is going to be important because I'm going to show you this is basically what's driving their return losses. As a result of entering late, the experienced guys look like they do better in mints. So basically what happens is that let's make a plot which says, what's the fraction of your collection which was minted by experienced guys, right? And then you have a very strong relationship. A collection which is minted by like 60% experienced guys has a much higher chance of minting out, and then mints a lot faster than a collection which has a very small fraction of experienced guys. So these guys look like they're informed. They look like basically when they buy a collection, they're buying the collections that happen to do well. But I'm basically arguing that sort of it's not so much that they're doing that. They're only buying collections when the collection is it's already clear that the collection is doing well. So they crowd in at the end, right? And the result of crowding in at the end is the following. We can run a regression where we regress returns on a dummy for seller experience and then controls. And then we can separately check returns with and without fees. What we find is basically if the experienced investors didn't pay any fees, right, then they would outperform in mints by around 12%. And then this is basically because of picking good collections that are likely to have high returns. And we can tell this because when we add a fixed effect for the generative collection, comparing collections that the same investor, so comparing an experienced and inexperienced guy buying the same collection, then there's no more return premium, basically. So basically what it looks like is that experienced investors are able to pick collections that do well. However, once we account for fees, experienced investors substantially underperform. And they underperform by even more when we compare the same collection. So what this seems to imply is that when experienced investors purchase in mints, they tend to pay higher gas fees. And then once you account for the fees, they are doing around 6 to 8% worse than inexperienced investors. Another way to look at this to sort of make a similar point is that we can run a regression of 4 different variables on seller experience. We can regress mint prices, gas fees, sale prices, and sale fees. And then so we want to test basically a hypothesis. Basically, when experienced investors are doing worse, are they getting sort of preferential access and then they're able to mint at sort of pretty good prices? Are they selling at higher prices? What happens to gas fees? What happens to sale fees, right? Experienced investors pay almost the same mint price as inexperienced. So basically the whales don't seem to be getting better access, allowing them to mint at lower prices. Mints are too cheap anyways, so this, like, qualitatively speaking, shouldn't matter anyways. But the thing is, they're not getting a huge discount on gas prices. They're paying quite a lot higher gas prices in comparison. So they're paying, like in this spec, around 7.8% higher gas prices. In the primary market, experienced investors also don't seem to be able to do much better in selling. So then their sale prices, comparing their sale prices are around 4% lower for a given generative collection than inexperienced guys. And this seems to be largely driven by market timing, because when we control for sale date, then the effect basically goes away. And then experienced investors have sort of somewhat lower fees overall when you consider sale fees, royalty rates, but this is largely driven by collection picking. So are the fees solely gas fees or are marketplace fees? So marketplace fees matter. They don't drive the inexperienced gap because of the fact that it's a 2.5% fee regardless of who you are. Yeah. So then the things driving the results are largely sort of when 2 people buy the same collection, the marketplace fee is the same, the royalty is the same. So the only thing that can really vary is gas fees. Yeah. So that's what happens in primary markets. And then in secondary markets, we can kind of do the same thing. We can look at like what's driving things in secondary markets. Here we have a relatively simple story, which is what it looks like is that the experienced guys are systematically doing better in secondary markets. This is actually true after you control for generative collection fixed effects. So what this means is that it's actually not the case that the experienced guys are doing better by picking good collections. If that were the case, then what should happen is that sort of this 6% should go to 0 once you control for collection, right? So we have a 6% overall, regardless of where we control for collection. Once you include fees, we drag down experienced investor performance to around 4.5%, but still consistently, the experienced guys are doing better. We want to kind of figure out what's driving the differences in experienced investor returns. And then so what we did next is we constructed synthetic returns. And then our synthetic returns, we kind of want to say like, is the experienced investor outperformance largely sort of buying at low prices, selling at high prices, or what combination of those, right? In a counterfactual world where we basically compare selling, like synthetic returns, where you sell, you sort of, okay, so then when you compare the actual returns of experienced and inexperienced investors, right? Experienced guys do around 4.8% better. If we assumed both experienced and inexperienced guys purchased at the index price, so we throw out the differences in their purchase price, then the experienced guys outperformance increases to 5.8%. So what this basically implies is that the experienced guys seem to be buying slightly higher priced NFTs. And so basically buying the higher priced NFTs means if you throw out that difference, the experienced guys' outperformance actually increases. When you assume they sell at the same price, that entirely eliminates experienced investors' outperformance. And what that implies basically is that when experienced guys sell, they sell at much higher prices. So you can think of it as experienced investors buy at around 1% higher prices and sell at around 6% higher prices. And the difference between those two is 5% outperformance, basically. And then so basically what seems to be happening in secondary markets, to summarize these 2 points, is that again, we find no evidence that experienced investors are actually able to pick collections in secondary markets on average. But we find evidence that their execution prices are systematically better. It's all execution. They're able to buy slightly more expensive NFTs and sell at, I guess, like far above floor, sell at very attractive prices. And that seems to be what's happening in secondary markets. Okay, so I'm basically done. I think I'm a bit early. So what we tried to do here is gather this like cool data set of NFT trades and then ask the question of like in this market for very, very heterogeneous assets, how much better are the experienced investors doing? And we find that there's like quite substantial outperformance. So 8.6 higher percentage points per trade, entirely explained by the fact that mints are more profitable and experienced investors mint more. And then so we find slight underperformance in the mint market and slight overperformance in secondary markets. And so what I want the takeaways from this is talk to be basically, so we uncover this like cool fact that there is a mint premium. I think this was like known somewhat in colloquially among sort of traders. Surprisingly, it seems nobody really documented this in any sort of academic setting, that mints are a lot more profitable than secondary markets, right? Experienced investors seem to, on average, be able to exploit the mint premium. So they're minting a lot more, and this is the greatest driver of their outperformance. And then so they have slightly better execution, but the interesting thing is that you might notice that like our results push a bit against hypotheses that experienced guys are able to sort of use insider information or access to gain profits, right? They have good execution, they mint a lot more, but they mint kind of late and they enter and they pay high gas fees, right? And so the idea that they're able to mint in a situation where they're able to mint without any pressure of gas fees or something doesn't seem to be happening in our data set, right? And then so I think that we shed some light on like sort of some folk tales about how this market works appear to be somewhat rejected by sort of our data pushes a bit against these folk tales that, oh, the market is super skewed and only the people who have access are able to make profits. Experienced investors are doing better, but they don't seem to be doing better by exploiting very asymmetric information or access, as far as we can tell with our data. And then, of course, the other idea here is that if you are new and then you are trying to buy NFTs, the market as a whole is doing well, but the guys who know what they're doing are doing better than you. And then so basically this is important to keep in mind when thinking about the returns if one invests in NFT investing strategies. Okay, so I'm about done. I'll stop there, and yeah, happy to take any other questions.
Awesome. If you have any questions, feel free to just unmute yourself or raise your hand so we can do it in an orderly fashion. Maybe I can go first. I collect some questions beforehand. This question is a little bit, maybe just, it says ballpark your answers. He said, you choose 50% for the cutoffs. Did you do any other like sort of criteria analysis or sensitivity analysis on what if you define experience differently and how would that skew the result? If you don't have the answer, what do you feel like the answer might be?
Yeah, I think that we tried some different cutoffs at the start. It didn't really affect the results much. We could do something where we bucket experience into more buckets. And then I think like that would be a more sort of non-parametric way to slightly like to show that like it's not super sensitive to the decision we made there. So yeah, great suggestion, and we'll probably add something along those lines. Yeah.
Awesome. And the second question is the 8.6% is from another person. His question was, can you explain in the briefest term what does this 8.6% mean, and what are some assumption you're baking into this 8.6%? Like given
So
what I think is what he's trying to ask.
yeah, so the 8.6%, the simplest way to look at this is the following, right? Suppose that I match every experienced investor trade to an inexperienced investor trade, that the buy and sell happen on exactly the same day. They might be different items, different collections, so on and so forth, but I take all mints, all secondary market stuff, and I match them, right? And I can ask, like, I take the average of all of the experienced guy trades, and then I take the average of all the matched inexperienced guy trades, right? And the matching strategy makes it so that sort of I make the holding periods the same. I make the market timing the same for both of the trades, right? I can ask how much better do experienced guys do? And then that's where I get the 8.6% from. Yeah.
Got it.
Yeah. Sorry, was there a second part of that question? I didn't quite get the second part. Yeah.
I think that was a question. Yeah. Hope that answers the question, whoever posted it.
Yeah. So any other questions?
I have one.
Oh,
This all seems super unintuitive to the narrative out there. Like how do you feel about that? Like why is there a huge discrepancy there?
Sorry. The result, which result in particular?
So I think the general sentiment is that experienced traders or NFT traders have a lot more higher returns than noobs, and sort of like these big traders dumping on the noobs to realize their profits. I think that's a one common narrative in the NFT trading space. I think this data doesn't show that much. It's only 8.6%. Everyone's gaining 60%. So what do you think is the driver behind that? Do you think the narrative is just not correct?
I think the market as a whole is doing quite well. I think the overall return slightly overestimates because the overall return, when we filter on traded transactions, ignores the fact that some NFTs basically go to zero. So then we decided to, in the main text, focus on sort of realized returns because it's hard to. What happens for the non-realized returns depends a bit on how you treat those, right? But I would like push back a bit, which is like 8.6% per trade is a very large number in any traditional finance setting, basically. So like, for example, like if you can get any investment today that pays like 8.6% return consistently annually, that is a very good investment. And being able to make 8% more for trades with holding periods in like weeks or months or so is actually a pretty large effect. So I guess what I would say is that it kind of like boils down to what did you expect there? For us, like 8.6, I think is like perhaps in the low range of what you would expect for crypto markets, given how insane they are. But I think 8.6% is on a very high end of like performance gaps in classic traditional finance. And so we we might put this in the paper eventually. We made a table comparing like estimates of how much the best VCs outperform, the best mutual funds outperform, the best traditional finance experienced guys outperform. And there's been literature studying these. And basically, like in most markets, outperformance is very small. The best guys do like 1 or 2% better than the other guys. The one market that's an exception is very good house flippers are also able to get like much higher returns, close to like 5 to 10% than like inexperienced house flippers. So basically, this seems to us to suggest that like the NFT market has a lot bigger experience premia than most traditional finance markets, but sort of not absurdly large, like in a range which looks similar to like how much good house flippers are able to extract from flipping houses or something. Yeah.
I can continue going, but I want to give time just to audience to not be shy and ask some questions. All right, I'll go again. On the introduction side, on the 3% of the wallet that fits the experience profile, my question there is, so you're saying the 50% overlap in mints and the 50% the 50% who do more than 11 who do trades on more than 11 collections, the overlap is only 3%.
Sorry. I am going to define a cutoff such that basically, like the way I'm going to define experience is people who made more than 6 trades did 50% of trades. People who made more than 11 secondary trades made over 50% of secondary market trades. I'm going to define experience as basically you're above the 50th percentile cutoff in both of these, right? Ultimately, I get 16,000 wallets responsible for around 30% of total trades. I should put 30% here. Yeah. Yeah, does that make sense? Yeah.
Yeah.
The 3%, 30% is basically just to illustrate that it's pretty concentrated. A small percent of wallets make a very large percent of trades. Yeah.
Got it. Also, did you happen to look into, out of all the experienced investors, like maybe like 1% of the experienced investor make up like 80% of the profit or something? Like, did you?
Yeah, we could look at that. I think it's probably the case that we're mixing like a bunch of very good people, traders, with a bunch of people who are like sort of pretty bad, but trade a lot, right? So I think another explanation for why 8.6% is perhaps a bit lower than you expect is that sort of not everyone who's trading a lot is actually good.
Yeah.
The econometric reason why it's safer to sort on how much you trade is that if you sort on how well you do and then measure how much better you do, econometrically, that's kind of tricky because you kind of like sorted on them doing better, right? There's less econometric problems with sort of sorting on another variable, which is how much you trade, because that is not mechanically related to the outcome variable, right?
Yep.
Yeah. So that's why we do it that way. But the thing is, like, if there were an econometrically nice way to deal with that, I think we're trying to find a way to do that. Yeah. So Arjun has a question. Do you think there's a difference between inexperienced wallets with a small amount to invest? And yeah. So this is a great question. Yeah, I don't have an answer to that. We didn't look at that. That's actually a very interesting thing to look at. Yeah. So
yeah, so I'll just read out the question for the recording.
Oh yeah.
Do you think there's a difference between inexperienced wallet that have 0.1 ETH to invest in a collection versus inexperienced wallet that have like 10 ETH? So an inexperienced wallet with low amount of ETH and inexperienced wallet with like 10 ETH. So does the amount make a difference?
Yeah. So yeah, we didn't do that. That would be pretty interesting to look at. So yeah, we might do that in a future version. So there's another question, which is one wallet might not be one trader. So we agree. I think we did some things to try and handle this, but I think that if you think about the direction that should drive our results, right, we should be underestimating how much experienced investors outperform. Relative to TradFi, I think the point of this paper is just actually the outperformance is already quite large. So I think that sort of that force, if some of our experienced ones are actually experienced, would make it so that we actually underestimate how much better experienced traders are. And so you can think of it as like 8.6% and possibly bigger if you think that we mistakenly called some experienced people, inexperienced people inexperienced because of your effect. Yeah. Yeah. Any other questions?
Is there any place where we can download your data set?
We don't have it public yet. There's a data set which is very similar, which is Moonstream. And so Moonstream has data which is like quite similar to this. I think we hope eventually, we are thinking of eventually making it public, but haven't done that yet. Yeah. But Moonstream has a version. It doesn't have like it doesn't have the time horizon as long as we do. But they have a pretty good data set on this stuff. Yeah.
Awesome. All right. So thank you so much, Anthony, for coming on and sharing this research. It's really fascinating to dive into the econometric side of the NFT marketplace. And thank you everyone for coming. And I'm gonna stay on Zoom for a bit longer for any questions if you want to ask during the recording. But once again, thank you so much, Anthony, and thank you so much for everyone coming on to the seminar. Have a good weekend.
Thanks a lot, guys. Super helpful comments. So thanks for I'll also stick around maybe for a minute or two in case anyone